You know, everyone talks about the AI boom, right? But what actually keeps all these massive supercomputers from just literally melting down? Well, to answer that, we just have to look at one staggering number, $2.64 billion. That is the revenue that walked through the door at Vertiv in just the first 3 months of 2026 alone. Let's get into it. Welcome to the EDGAR Brief. Today, we're cracking open the Form 10Q from Vertiv Holdings Co., ticker symbol VRT. This was filed on April 22, 2026, and we are going to translate it from accountant into plain, everyday English. Now, quick note before we jump in. We are entirely independent, not SEC affiliated, and definitely not your financial advisors. We use AI to help summarize these incredibly dense documents, so, errors can happen. Always verify the numbers on sec.gov before making any money decisions. Okay, let's do this.
So first up, what exactly does Vertiv do? If you read the actual filing, they say they provide, and I quote, mission-critical digital infrastructure technologies and lifecycle services. Yeah, that's a mouthful. Let's translate that corporate jargon. Basically, Vertiv sells the physical hardware. We're talking the heavy-duty power management and the massive industrial cooling systems that literally keep data centers and communication networks from overheating and completely shutting down.
Actually, think of it this way. If AI supercomputers are a giant gym packed full of massive bodybuilders just working up an incredible sweat, well, Vertiv is the landlord providing the specialized power outlets and the massive industrial AC units so nobody passes out. And the money? It comes in through two main doors. They sell this highly complex equipment up front, and then, here's the kicker, they sell the lifecycle services and all the spare parts to maintain it over time. It's a classic recurring revenue setup.
All right, let's move right into Section 1, the scorecard. We're looking at the numbers that really matter here.
So, the big question, are more dollars walking in the door compared to last year? The short answer is an absolute massive yes. First quarter net sales jumped from just over $2 billion in 2025 to a whopping $2.64 billion in 2026. Guys, that's a 30% jump in a single year. For a heavy hardware business, that is huge. And honestly, even better is their gross margin. That tells us for every dollar sold, how much actually sticks to the wall before they have to pay for things like payroll, ads, and rent. That expanded from 33.7% to 37.7%. Why? Because a really favorable mix of complex products and maintenance services is sticking, and it's driving some incredible operational leverage. As a result, operating profit, the actual money made from running the business, skyrocketed by over 50% to $440.1 million.
But here is the most crucial point, and it's a core rule we always live by: cash flow beats accounting profit. Remember, profit can be a fiction cooked up by accountants. Cash simply isn't. Vertiv reported a net income, their accounting profit, of $390.1 million. But if you look over at their cash flow statement, the real cash generated by operating activities was an astonishing $766.8 million. Basically, the actual cash stacking up in their bank account is almost double what the accounting profit says. Why? Mostly because customers are just paying them up front. Right now, this company is an absolute cash cow.
Moving on to Section 2, the moat check. What exactly protects them from the competition?
So what stops the competitor from just walking in and crushing them tomorrow? Well, Vertiv's competitive moat is built on incredibly high switching costs. Just think about it. Once Vertiv's complex thermal management and power infrastructure is physically wired and plumbed deep into a massive data center, you can't just easily swap it out. I mean, unplugging Vertiv's liquid cooling systems from an active AI data center, it's literally like doing open-heart surgery while the patient is running a marathon. Downtime is absolutely catastrophic for their customers. This means once Vertiv is in the door, customers would absolutely scream if they had to leave.
Okay, Section 3, reading between the lines, specifically looking at management's discussion and analysis.
Now, let's look at what management is really emphasizing this quarter. In this filing, they are just laser-focused on the AI gold rush. They explicitly state that the continued adoption of AI and high-performance computing is driving increased demand for data center infrastructure. The computing power required for AI is so intense right now that traditional air conditioning just doesn't cut it anymore. Customers are rapidly shifting toward incredibly complex, high-density liquid cooling architectures, and Vertiv is perfectly positioning itself to be the premier vendor selling them those advanced systems.
And honestly, this next point brilliantly illustrates how management is putting their money right where their mouth is. Just look at their capital expenditures. This is the real hard cash spent to build new factories and expand their physical capabilities. In Q1 2025, they spent $36.5 million. But in Q1 2026, that number completely tripled to $112.6 million. They are aggressively pouring cash into expanding their global capacity to capture this unprecedented AI demand. They know the demand is out there, and they are basically racing the clock to make sure they can build enough hardware to meet it.
All right, time for Section 4. Red flags. What could actually go wrong here?
Well, it's not all perfectly cool data centers, right? Let's cut through the standard lawyer-written boilerplate and look at the actual specific risks here. First off, there is some lingering legal baggage. Vertiv is currently fighting a 2022 securities class action lawsuit, with claims under Section 10B still pending. Essentially, some shareholders are alleging the company previously made misleading statements about supply chain pressures and pricing. And related to that, there's a consolidated derivative action brought by shareholders. Now second, and this is interesting, if you dig into their balance sheet under accrued expenses, there's a $177.3 million contingent consideration liability tied to a recent acquisition. That's essentially a floating future payout they owe based on performance, and it recently increased by over $33 million, hitting their operating expenses directly. Definitely something to keep an eye on.
Which brings us to Section 5, the bottom line, our EDR's verdict. All right, so we've looked at the money, we've checked the moats, and we've weighed the risks. So, what's the verdict? Vertiv is a massive, cash-generating picks and shovels hardware play. Look, in the AI gold rush, they aren't the ones out there mining for the gold. They're the ones selling the highly specialized, wildly expensive pickaxes and cooling fans to all the miners. Their main strength is without a doubt this unprecedented AI demand, coupled with switching costs so high that their customers are practically locked in. The main things we'll need to watch in the next filing will be whether they can execute on this massive capacity expansion without a hitch, and just how much that pending legal baggage might ultimately cost them. So, the big question we're tracking for next quarter is this. Will all these aggressive factory investments pay off fast enough to capture the demand, or will the sheer operational complexity and the intense heat of the AI boom start to melt their profit margins? We'll have to see. And that is your EDGAR brief on Vertiv. Remember, this was a translation, not a recommendation. Always read the original filings on sec.gov if anything here piqued your interest. Thanks so much for being with us at the EDGAR brief. We'll see you in the next filing.